Okay, well, let's shift now and have a chat about broader markets. Nick Twidale from FP Markets joins me at the desk. Nick, it would seem that things are looking a little bit more buoyant out there in terms of risk appetite.
Certainly are, aren't they? I mean, overnight we saw, European session and the US session, like massive gains for stock market indices across the board. I think NASDAQ finished up 1.8%. I think there's a lot of investors that are hoping that 2 weeks ago just didn't really happen, and in a few months we'll forget about it and we're back in the main game. I don't necessarily agree that that's going to happen, and I think we've got a lot of traders that are sitting there still with a very, very wary eye on the news wires to see what the next potential issue or market turmoil comes from. But it puts us in a bit of a strange dilemma, doesn't it? Because now if it is good news, are we then going to go back to seeing tightening from central banks?
Absolutely. I mean, well, I suppose the next discussion really is going to be this whole notion of a pause. And obviously, the Fed put it on the table. Wouldn't say they did anything more than that, because it was slapped down any notion of a cut and what have you. But last week, they put the pause on the table. With the RBA, it seems to be, almost the base case now. Had these job openings, vacancies figures today, inflation data a bit softer than expected yesterday. Just when it comes to the RBA, as well as obviously Aussie equities as well, sentiment there, we're sort of lined up for, potentially the end of the rate hiking cycle, I guess.
I think we are. I think it's sort of an interesting, and obviously I normally look from things from a currency perspective. I think we could have that situation where we get that perfect storm that is a bit of downside correction for the Aussie. We've got the RBA now, and I think sometimes and let's be honest, we're a smaller economy than the US when we're looking at the major. We have had a reaction, and rate hikes have started to take an effect. So the inflation number, I think, is probably key for us. So, if we are looking at that, and we are looking at cuts even coming before the end of the year, which everyone's talking about, then maybe there is a strong case to see the Aussie come off and a little bit of normalisation for our market. Obviously the opposite side of that trade is the Fed for the majors in the currency. They may have to go back to tightening, because the numbers, if we take out, like some people are hoping, the last few weeks of turmoil and bank closures and Credit Suisse and everything that we've seen, then the numbers out the US are still strong. So there's a potential from an interest rate differential point of view that there's big downside for the Aussie.
So what do you reckon is going to drive that story then? I mean, obviously it's always difficult to kind of weight these things, but we've got the rate differential story, which is very much just like you've outlined. The China story, interestingly enough, has sort of shifted to the background amidst all this kind of turmoil. Then there's just the sentiment proxy. If things start to feel a little bit better, Wall Street starts to rally, the Aussie dollar seems to do okay in that situation. I'm balancing all those risks. Do you think as we can see it right now, that the risk is skewed to the downside for the Aussie, or because these banking issues are starting to improve, if you can say that maybe it's a bit of a risk on rally in the making? What are your thoughts?
I think we are stuck between that rock and a hard place when you take all those factors into consideration. I always like to go with that sort of pure fundamental view that interest rate differentials are going to win out in the end. So probably it's a grind lower. I think the issue for the Aussie in particular is if we do see something that does hit the market, so we see a downturn in China, we see some more market turmoil. No doubt in a lot of banks around the world, and central banks, as we know, there's a lot of evaluation going on at the moment of risks within the market. If that starts to creep back in and investor sentiment turns down, then the Aussie will get a bit of a tap. But as you said, if everything looks bright as it did last night and has done for the last couple of days, then the Aussie will get a bit of a lift from that.
Another question, and final question, if I may, just on the subject of gold, because it was the beneficiary of, I guess you could say, a play out of fiat, might be the appropriate way to define that, as well as the fact that obviously the whole banking situation has led to these expectations of effectively cut, so yields have come down and what have you. Now though, gold seems to be reversing a little bit. I mean, do you have a view there in terms of what we could have in store for gold going forward? Yeah,
I do. It's a tricky situation with gold because it's been trading so well with US dollar yields and the US dollar outlook. And then as soon as something really hard hits the market, as it has done, then bang, it's a safe haven play. And it took off and went up to 2,000 pretty sharpish. If you look over the last month, I think we were down about 1,850, and that's a big move up to 2,000 plus. Now I think, like a lot of the currencies, gold's sort of sitting in a watch and wait, but it's watch and wait with $10, $20, $30 on a very quick move. I think it's going to trade more consistently as a safe haven over the next quarter because I think the market's now got that in its head. But then if we do see this sort of normalisation, this back to what we've seen for the first part of the year, then I think you'll then start to see the correlation come more consistently with the US dollar play. So it's a tricky, because you can argue both sides of it. It's great sometimes for us, and it's really hard for us because it makes it very difficult for us to make a call because we're not entirely sure what the big players are moving at. And I think they're switching from one mindset to another quite rapidly at the moment, and that's what makes it so difficult to do. But I mean, at the moment, I think there's a top on it around about 2,000, unless we see any other increase in market turmoil and investor sentiment decreasing. And then the other side of it is, where is fair value for gold at the moment in the current environment? I think we've got to see a shakeout in data for the next probably 2 or 3 months, if we're really honest, to see where the global economy is, if we're going to see growth, and if there is going to be any more sort of downside, which means safe haven buying for gold.